these short squeeze stocks that we put in a list every single day can go parabolic. The market is looking at this hike next week and absolutely shrugging. It's completely shrugging because it knows, and a lot of people seem to have found out, particularly JP Morgan, and I want to kind of dig through that deck that I have been given. The idea here is that liquidity will expand, and that the October period that we witnessed, that was the bottom of the liquidity cycle. That is hard for a lot of people to admit. But when you look at the way that this whole system operated from the dates of 2021 all the way until 2022, the cycle has looked like this. The Fed started raising interest rates in 2022. That led to crowding into the US dollar. And let's just take a real quick look at the simplest thing that you can to analyze the movements of the US dollar. If we look at the DXY last year, is this going to take me where I need to go? There we go. 1 month chart. There we go. If we look at this period of time from 2021, this is where the rate cycle starts. And it kind of, tops out for the dollar. Hold up. DXY. Yeah, there we go. That 2021 period, the US dollar became a very, very crowded trade. At the beginning of 2022, started up at 112. Now, if we look at the weekly numbers and we go into last year, you're up at 113, forgive me. 113, this is the duration of the rate cycle going from last January, taking us up to 112. This period right there, that 925 period, that is the bottom of the market. That is where all of the insiders stepped back in and bought. That is where we saw a significant amount of crowding into the U.S. dollar. That's where the dollar strength was the highest. This is where the British crisis happened. This is where the gilt crisis really existed. And even though the Fed was continuing to raise rates into this year, liquidity started to move through the global system. That started with the Bank of England. Obviously, the Federal Reserve stopped selling mortgage-backed securities. They provided, an expansion of economic conditions. Then you started to see the Bank of Japan ease, and the Bank of Japan eased so much money that it effectively offset all of the expected tightening from the U.S. QT. And then from there, you had the Bank of China with its opening of 2023. Lots of liquidity. Now, you had this March crisis kick in. There was a lot of money that flowed back into the U.S. dollar. The U.S. dollar is the instrument of safety. It is the place that people want to be. That is where liquidity gets sucked up. So you had another liquidity crunch in March, but sure enough, the Federal Reserve stepped in and provided capital to those banks, which then turned around, paid very, very little to their depositors, and then has been lending. With the case of JP Morgan, prime rates, 8.5, in certain things. So there's this craziness to this environment where more liquidity was pumped in. Now, meanwhile, fiscal policy or monetary policy tightening interest rates, people effectively view interest rates as the price of money, but it really is the price of premia of money. And as a result of that, the U.S. dollar has really peeled back. And now the expectation is that the DXY could continue to fade and move down to as low as 90, which would be a number that we really haven't seen, I think, probably going back to the beginning of COVID. So if that is the case, more weakness in the U.S. dollar can create a couple of things. One, it can provide some relief for the yuan, and that may be why Yellen went over there in the first place. If that is the case, China may ease some more. That's good for the global markets. In fact, the chart that I showed this morning, the correlation between the MSCI World Index, which is all global equities, and global liquidity as measured by cross-border capital is a R-squared somewhere around 0.93. That's massive. That is a massive relationship between equity prices, risk assets, and global liquidity. So we have to be paying attention to this, because this whole situation for so many people is defying logic. I've talked about this a couple of times, but what I had said about October, my expectation, my viewpoint of October, was that something else happened in the market. The idea that there was more zero date options, or the idea that there was more AI involved, and that as a result, we were seeing more and more dip buying. No, actually, it was something as simple as there's just more liquidity in the system. So in June, when we saw the SPY take off like a rocket and the momentum indicator went positive, and we sit around and we say, well, what is it that's driving that? Why is it going positive today? Oh, that's right. Same thing that happened back here in June 3rd, where we were like, oh, why is momentum going positive right now? And not really thinking about it, not really understanding what the rationale of it all was. It was because back then, at that time, China was easing. And then on June 1st, China was easing another trillion in yuan. And now, as we look at this very frothy top of this market, recently in July, because of the yuan's weakness, the Chinese central bank tightened by $1.2 trillion or yuan. So there's concerns right now that a liquidity crunch could kick in very, very soon, which is why it is possible that Miss Yellen made that trip. In addition, we saw what has effectively been the accusation of weaponization of the yen against the Chinese yuan. And as a result of that, well, as we look at it, this market does seem very irrational to people. And it certainly is irrational when you look at a lot of these crazy stocks that have no business rallying the way that they are, and Carvana going from roughly $8 to $55. Let me just explain one quick thing about this. When your momentum cycle gets very long in the tooth, and capital is coming into this system, and there is ample liquidity in this system, if that period of momentum remains strong for a longer duration of time, these short squeeze stocks that we put in a list every single day can go parabolic. And that is the case here, because it started out slow. And then, look, I don't know how long these cycles are going to last, but they've lasted for 35 days. And now, all of a sudden, Carvana, because of all of the squeezing, because of all of the people short covering, this stuff absolutely rips higher. Now, what is Carvana worth? Probably $1, probably $5. So if we end up in a cycle soon where momentum goes negative, all of this stuff that has squeezed is right too short. But that would require a relatively longer period of negative momentum. And you need to make a 10 to 15 day period. You'd be talking about Carvana going from 47 down to 20 like that. And there's obviously proof of that happening. This was that August period last year. We had that negative event. And the cycle for the markets, the stock was back at 54. It ended up the year down at $5. This is really it. This is really the massive takeaway. And to me, I'm sitting here thinking there's no way it's just this simple. It can't be this simplistic. I've had other people in my ears saying, oh, it's macro bullshit. It's macro bullshit. It's macro bullshit. But as I've spent literally the last 3.5 weeks sitting here looking at this and looking at the cycles and looking at the liquidity movements, it's pretty spot on. It doesn't have to be 100% of the accuracy, but in reading the cross-border book, I just reordered it. I'm going to sit down and really dig through it. The reality is that capital in, capital out, liquidity, broader understandings of central banks and shadow banking and everything else, that's been the driver. And Druckenmiller talked about this back in 1998. He talked about it in 2018. This is what these big funds are watching. So this is where my head's going to be.